you come back to inevitable, and then it's kind of hits you over the head how there are these little memes that number go up. That in 3 words is what Bitcoin is designed to do, and it's this oversimplification of these mechanics and the nature of Bitcoin. But number go up.
Wait, before we get too deep, guys, I do have a warning here off the top, and that's that I just finished eating 7. Yeah, you heard me correct. 7 chorizo and steak tacos. So if I disappear during this chat, you two will know exactly where I am. They were delicious, but they have explosive potential out the back end.
They do. Dude, chorizo is a dangerous thing to play with, my friend.
Yes, it is.
Jesse, Dan and I don't often work together. So yesterday we were working together, and a gentleman named Phil, bless his heart, decides he's going to bring in some venison for us. And which is a really cool gesture, to bring in something to cook it for guys all day. But Dan and I saw it in his eyes as well in the morning. We were like, what are we getting into here?
And Phil's a good cook, by the way. I need to chime in here. He said he's a great cook.
He's probably a top 10 cook.
Potential. Yeah.
But he pulls out these cuts, and they look very muscular. There's no fat in these things. I don't even know what part of the deer this is from. It was probably the leg or something. We had a busy day, no time to let these things cook properly. One of the worst meals I've ever had at the firehouse last night. And I'm sorry to say this, Phil. It was bad. And you could tell he knew it. My only comment to him when he asked how it is, I was like, it's different.
Talk to him right now. It's be honest. Different. Level with him. Yeah. Josh was like, I've never had this before. I've never had anything like this before.
It's different.
Phil, you're a great cook. If you're listening, we love you. We appreciate you in the kitchen, but it just the timing.
We were not honest with you, Phil, though. We pretended like it was okay. It wasn't. It wasn't okay.
Was this before or after there was bicep measuring going on in the firehouse?
Oh, that was at like 8:30 in the morning. We had Jim, our friend Jim, our good friend Jim. We noticed he was, he's flexing a lot that morning, and we're like, dude, I think one of your arms is smaller than the other. So we got a measuring tape out. We verified it. One arm is 1/2 inch less in diameter or in circumference than the other. So he's got some work to do. His right hand is doing more work, which is not unusual, but he needs to even this out. He needs symmetry if he wants to pretend that he's some kind of firehouse demigod, which he thinks he is.
Jesse, you are one of our favorite guests. We are ecstatic to have you back on Blue Collar Bitcoin. We spent some time with you in person in Miami, so it hits different this time. It's good to see you. What's going on? Give us a window into your world here today.
Window into the world. First of all, great to be back. I love the vibe here on Blue Collar Bitcoin, and it's fun hanging out with you guys in Miami. I understand. I missed the big night for you guys, but
one day you'll make it.
Yeah, another time.
We'll impress you.
Yeah, in terms of window into the day, just setting up Onramp Bitcoin, and also writing Once in a Species. Which has been 2 things that have consumed my plate entirely of late. For people who aren't familiar, Onramp Bitcoin is a new Bitcoin trust, and we are intending to, and we have built a trust that does what GBTC should have been, in our view, in the sense that, one, there's a multi-party custody. So 3 different institutions hold the keys to the Bitcoin vault. Mm-hmm. We are one of the 3. And in that sort of arrangement, there's no ability to rehypothecate Bitcoin. So, the Bitcoin sits on chain, and it can't move unless all parties involved, or 2 out of 3, agree. And that's at the behest of clients. And then the other potentially even bigger advantage of this trust model is that there's no taxable event when you decide you are ready to take on self-custody of your Bitcoin. And that's different from these other existing trust models because most of them don't allow you to withdraw Bitcoin, first of all. So what you're allowed to do is withdraw your dollars, which means you have a taxable event since you've been in Bitcoin exposure,
Right.
but you're only allowed to withdraw dollars. And then you have to turn around and buy Bitcoin, now that you've had that tax hit from your capital gains. So, and it doesn't have to be that way. You can have a trust model where you can take possession of your Bitcoin, and it's not a taxable event because you have held your Bitcoin in the trust for all that time. So that's what we're building with Onramp Bitcoin, and we think that it's a better way to get people started in Bitcoin that sets them up to take self-custody down the road, such that people don't need to be going through these inferior trust arrangements, specifically Grayscale or some of the other ones out there. Going into this next cycle, hopefully we can steer people in a better direction.
Wow.
On the Onramp idea, while we're talking about it, can you give us an idea of what your typical institutional customer looks like? Are they just not comfortable managing these keys themselves, but they also do understand some of the dangers that GBTC inherently has after watching this thing perform over the last couple of years? Give us a bit of an idea of like who are the customers Onramp is geared towards.
Yeah, so it's for high net worth individuals and institutions. We are limited by it has to be accredited investors, and part of that is we have a $100,000 minimum. Some of the things that institutions in particular care about is they're aware that most existing products are you're trusting some single point of failure, a singular counterparty, or in fact, oftentimes a chain of single counterparties. So, if you have Coinbase custody, you're ultimately trusting Coinbase, and it's a black box of how they're doing their custody. And that if the government was going to 6102, they would send a message to Coinbase first and foremost, because it's the biggest honeypot of Bitcoin out there. And what are they going to do? They're going to turn over the keys. So some folks are aware of that risk and concerned about that. For others, for institutions in particular, if you're on an endowment and there are 5 people on the investment committee, and you decide you're going to have a little Bitcoin position, well, who's going to hold the keys? Who's going to set that up on behalf of the institution and control that? Is it going to be one person? How are you going to handle those decision rights and the roles and responsibilities around that? And so this model is, within the realm of what an institutional allocator like that would normally deal with. They're sending money through to a trust, which involves subscription agreements and documents up front and an onboarding process. And then the decision rights are maintained for the institution as a entity, without a single person having to hold keys and take on that responsibility, and then also the risks of commandeering it. So I think those are two of the reasons that institutions in particular find this model attractive, and frankly, it's better than anything else that's out there. If you're thinking about how do I get exposure to Bitcoin without taking on self-custody, and obviously everyone should be heading towards self-custody because that's the end state of this all. But people who are just getting into Bitcoin, most people are not ready for that,
right,
especially at an institutional level. So this is a better way to get started, we think.
So here's what I'm thinking, Jesse, while you're talking. I'm thinking about the difference between current public perception and reality. So for the average institutional, high net worth family office investor, especially after the events of the last, say, year and a half, they have Bitcoin probably lumped in the crypto space as unhinged, incredibly risky, massively over-levered. And your product is architecturally exactly the opposite. Conservatively designed, extremely conservatively designed in a way that's impossible really in legacy finance. So it's so different than it would first appear. And it's a manifestation. What you're building is a manifestation of the fundamental difference between Bitcoin and crypto that is still not entered public discourse and in public awareness. Hence the opportunity for people to get it. But in a lot of senses, what you've built there, that model you've built, is totally devoid of leverage, completely transparent, and certainly done the right way. So I commend you, because this isn't just an upgrade. This is a really, really significant and needed upgrade in that space.
Yeah, thank you. I think we'll just have you do our marketing stuff from now on, because that's a perfect summary of exactly why we feel passionately about this product needed to exist. This is a better way to do what has been done by a bunch of other people who have come in from traditional finance and have done it the traditional finance way without leveraging Bitcoin's native properties. And this model enables, it takes advantage of what Bitcoin does so well, which is custody, and multi-signature custody in particular. So yeah, we think it's a better product because of it.
Hey, Jesse, I have a bit of a logistical question for you. Since you're involved in this and they're holding keys, at least one portion of, say, a 2 of 3 or 3 of 5, this is a question I've kind of wondered for quite a while. Never had a chance to ask anyone who's involved in this. How do these companies that custody, like say your Unchains of the world, your Coinbases, how is it exactly that they hold these keys? Do they air gap these under like an air gap system? I'm sure they have some redundant backups, but what I'm imagining they don't do is have, a bunch of Trezors or a bunch of cold cards. They can't, that doesn't scale. So give us a rough idea of how that setup works in the background with some of these key custodians.
Yeah. It's funny because people don't talk about it really, because nobody wants to give away what they're doing. Nobody wants to introduce that risk. So you kind of pick up things here and there, but I still don't fully know what the different parties in the space are doing. But you're right. People aren't running around with Trezors. They've got a more, more industrial, air-gapped, multi-sig approach usually, and these things are kind of done in bespoke ways too. And some of them, talking to some of the older service providers in the space about how they do things, some of them are a little bit hotter than cold.
Yeah.
Than
that's
you
your old
expect.
Mt. Gox where you just had a thumb drive that had $1 billion worth of Bitcoin on it.
Yeah, and
connected to the computer.
A good chunk of I think what I've gathered, and I can't say this with any definitive claims, but what I've gathered is that a fair number of service providers are doing something with hot keys that are sharded and then stored in a bunch of different places, such that they've created
we start giggling whenever we hear the word sharded. Sorry, Jesse.
It's not your fault. we had an episode what was it, a couple weeks ago with Daz and Seb, where sharding came up and it sounded like a T, and we're just immature firemen.
I tried to hold it. I tried to hold it in too. I'm giggling. Sorry.
And Dan had tacos, so he's thinking about sharding.
Yeah.
Yeah, that's his cue. Yeah. And so anyway, I don't fully know. But everybody has their own little bespoke service that or setup that they've been running with, and the longer they've been running with it, the more antiquated some of them are, I think. But that paints a little bit of a scary picture of it. But I think that
I think what you're trying to get at though is that basically, but it's one of those things you don't want anyone to know.
Yeah, and everybody's done something that's pretty robust, if a little bit outside of what you would quote unquote call best practice.
Yeah, it makes sense that it wouldn't share anything though. But I have been curious. I bet some of it's a little more archaic and simple than we might imagine.
Yeah, I'm what I'm kind of imagining in my mind is that if you guys ever seen that South Park episode where they have the router fails and in order to get the internet back on, they have to just unplug the router for 30 minutes or 30 seconds and plug it back in. And it's this big thing. It's just a giant router. Anyway, I digress. It's just a giant cold card.
Yeah.
Dan, that's all it is.
100 times larger than normal, same features.
Same thing.
Let's pivot into U.S. fiscal dynamics. So the outline we had for this is to talk current fiscal situation, debt debacle, inflation dynamics, and then maybe if we have time, parlay into Bitcoin valuation, halving, get some bullish boners fully erect as we exit. But I want to start. I'm going to read a quote of yours from one of your pieces. Your writing is really good, man. I mean, you clearly spend a lot of time distilling this down to make it as short and punch-packed as possible, and we appreciate that. Here's one quote from a piece you have on the fiscal situation. When it comes to the United States fiscal position, we have already passed the relative event horizon, even though most people think that we're still in the safe zone. What is this event horizon? Why don't you start us off on some high-level thoughts about the fiscal fiasco, and then we can go from there.
Yeah. Okay. So in terms of the black hole metaphor here, I think of the U.S. national debt as a black hole. Funnily enough, I also think of Bitcoin as a black hole on the world's balance sheet. Those are the same metaphor in two different directions. One's a good black hole, the other is not a good black hole. In fact, when you put the U.S. national debt on a chart, you know where we go further and further in the red going down, it sure starts to look like a black hole too. It has an incredible, the growth over the last 50 years in particular has accelerated in a parabolic way and not in the direction you want it to be going. And so what that does is creates a gravitational pull for, let's call the U.S. a little spaceship out here in space, and the black hole is pulling at us because of interest expense. So when you have debt, you obviously have to pay interest expense on that debt every year, and that's the gravitational pull because you have this line item in your budget that has to be paid, which is your interest expense for that year. And for the last 10 years, the interest rate that we've been paying on our debt has been basically zero. And that's because, the Fed has had interest rates down at zero for the better part of the last decade. And obviously in the last year, that has changed. So now interest rates are up at 5%. And the national debt is catching up to that rate. The rate that we pay it's a weighted average of the duration of the instruments that it's held in times the rate of the interest rate that at the time when those contracts were created or rolled over into that current contract. So right now we are on our way to a weighted average of 5% interest rate on that. I think we're about halfway to that. And we have $31 trillion of national debt. So if you have 5% interest rate on $30 trillion, that's $1.5 trillion a year in interest expense alone. So that's like if you have a credit card, you're running a balance, they charge you interest every month. You're not getting anything for that. You're just treading water with that. You're fighting the force of that debt getting bigger. And so that's the gravitational pull that's pulling us in towards this mass that we've created, the national debt. And I talked about the relative event horizon because obviously we know that with a black hole, there's an absolute event horizon. The quote unquote event horizon that we normally talk about is actually the speed of light event horizon. So that's the point beyond which light can't escape the gravity well of a black hole. and light is the fastest thing in the universe, and nothing else travels as fast as light. So we think of that as like the danger point, where once you go past that magical threshold where light can't escape, then you can't escape. Obviously, if light can't do it, then you can't do it. But what we don't think about is how, since we can't travel anywhere near the speed of light, our actual relative event horizon is way further away from the black hole, because there's some threshold beyond which we cross, where whatever the maximum speed of our spaceship is, we cannot offset the gravitational pull of that black hole beyond some invisible threshold there. In fact, a threshold that you can see stuff beyond it, because light can still escape, but your spaceship can't. And I tried to pull that into this piece because your ability to escape the black hole is only as good as your maximum velocity, your ability to pull yourself out of that hole and to move away from the black hole specifically. And then when you look at like, what are politicians doing to fight the gravitational pull of $1.5 trillion of annual interest expense on our national debt? They're not doing anything. In fact, if anything, we're heading straight towards the black hole, because we can still see it, and we're clearly still far enough away that there's no danger. And yet we spend $800 billion on the Department of Defense every year. I think that's the number.
Yeah. Yeah, it's pretty close to right.
So the interest expense is rapidly approaching twice what we spend on defense. And where is it coming from? It's not, in fact, it's not coming from anywhere. We're taking on more debt to pay for it, makes the black hole have even greater gravity. And you can see how this system doesn't end well. It is right. We are in a gravity well that is pulling at us to the tune of $1.5 trillion a year. And we're already unable to balance the budget. We are currently on track for a $2.2 trillion deficit this year. So we're already adding to the gravity well every year. And now we're going to be adding even more because of this interest expense. It's pulling us in to the black hole. Mathematically, it is only possible to get out of this at this point in time if we were to radically cut spending and somehow increase productivity and somehow increase tax receipts. Those things would have to happen at the same time. And you look at Washington, that's not happening. Nobody's cutting spending. The debt ceiling deal that they were fighting over amounted to nothing. There was no concessions.
Shocking too, right?
Absolutely nothing, Jesse. After reading your thread on the debt ceiling, I just tweeted a few minutes ago. I said, the debt ceiling being lifted and the Dems agreeing to freeze spending at existing levels for 2 years is equivalent to a dude who's currently racking up $30K a year in credit card debt, telling you he's going to rein it in by keeping his cash flow as is. And this is, in a lot of people's minds, a manifestation of austerity and them locking it up. Yeah, we're locking it up at $2 trillion deficits. I mean, we're so far from any tangible austerity. It's not even funny.
Yep.
Yeah. So in that piece, you mentioned that 129, we're at 129% debt to GDP. It's something like 95 to 98% of countries that hit that. I think the only one you identified that has hit above that was Japan, and they are in the course of circling the drain right now. So with your analogy you're drawing, they are right now, Japan is breaching the event horizon and they are getting sucked in, and we're not even going to see what happens to them because they're going to disappear behind the veil. But what is it that can happen to these countries? What is it that generally happens? It seems that there are two disparate paths. We're going to pick one of them. Outline for us, what are the two paths that generally happen to a country once the event horizon has been breached? What happens to all of when we get shot out on the other side of the universe through that wormhole?
Yeah. So I think one thing you can think about is if a country is small enough, they can be propped up, they can be bailed out. Greece 10 or so years ago had this happen where their fiscal situation got out of control and the EU just saved them. And that's fine if you're Greece, but it's not going to happen if you're the United States, or the EU for that matter. And so that's off the table for a larger country, or Japan even. Japan's too big to be saved in that way. So what ends up happening is you have to screw over the people who are holding the debt that you've pledged. You say, so who holds the $31 trillion of U.S. national debt? It's a mixture of foreign central banks, foreign sovereign wealth funds, foreign investors, foreign companies, and then wealthy individuals, and in their portfolios they don't even realize what they're holding, but they have some of that in there. Corporations in the U.S. and then like Joe the plumber types have some little bit of their. If you have a portfolio and it's a 60-40 portfolio, that means you've got 40% of it in bonds, and some portion of that is in U.S. Treasuries, which is how the debt is issued.
Yep, so, and some portion of that plumber's pension fund as well, I'm sure.
Exactly. Probably a large portion of that pension fund.
Yep.
So those are the people holding this debt, and what do they have? So there's 31 trillion of this debt out there, and soon it will be promising 5% a year of yield, for return for those investors, as a thank you for letting us borrow money. And that's great so long as inflation is below 5%. Right. And if it's above 5%, then you're getting a negative real return, which is happening right now because the official inflation statistic might be around 5%, but the unofficial inflation, when you go to the grocery store, when you try to do anything and you notice what it cost a year ago, it's more than 5% more expensive. I think it's, according to the Chapwood Index, something like 10 to 13% right now in the US. So what happens when you have to default? That's what it's called, defaulting on the debt. You say sorry to all those people holding those promises for more real returns over time, denominated in your currency. And typically what you do is you soft default. So you don't send a letter saying, sorry, we're going to renege on these contracts. Instead, you just print a bunch more money. And that makes it easy to pay the nominal contracts that you've pledged, because now the dollar is worth so much less. So if you were to print a bunch of money, the dollar's worth half as much. Suddenly that debt in real terms is worth half as much, and it's easier for you to service and get out of. Japan will probably have to do something like that, and and every other country on earth is rapidly following. In fact, with smaller countries like Argentina, Venezuela, the classic Zimbabwe, I think Turkey right now. This is happening to them faster because they're the canaries in the coal mine. Their balance sheets are worse, and they have people don't want to hold their debt because they don't trust that country for whatever reason. They don't trust the balance sheet of that country, and so they have less wiggle room before they have to print a bunch of money and cause a bunch of inflation and inflate away the debt. So all that to say that the only way out is some kind of default. So Josh, what you were talking about is since 1800, 51 out of 52 countries that have ever reached 130% debt to GDP defaulted, whether through soft default or hard default. And it's always a soft default because that saves face for the politicians and they never have to fess up and say, we're reneging on our pledge.
Howdy plebs, it is Dan here. I want to take a minute to talk to you about Crowd Health. What Crowd Health is doing in the healthcare space is nothing short of remarkable. If you're already familiar with Crowd Health, you can visit joincrowdhealth.com/BCB and use code BLUE for a tantalizing 3-month trial discount. As you probably know by now, the two of us are career firefighter paramedics. Nearly 70% of our calls are medical related, and we both rotate over to an ambulance. We're the first link in the chain in the healthcare system, and we see just how broken it is. Injured and sick patients stressed out of their mind, primarily worried about the incoming hospital bill. Crowd Health offers an extremely simplistic and workable alternative to traditional healthcare setups for a freaking fraction of typical premiums. It's essentially the decentralization of healthcare, leveraging the power of Bitcoin alongside healthcare crowdfunding to drastically uncomplicate healthcare and give back control to patients. Crowd Health negotiates bills for their members and finds them the best doctors and hospitals. Do yourself a favor. Visit joincrowdhealth.com/BCB. That's joincrowdhealth.com/BCB. And use code BLUE during sign up to receive a max discount crowdfunding request of $49 a month. Yes, $49 for the first 3 months. The Blue Collar Bitcoin podcast is brought to you by arguably the most legendary company in Bitcoin, CoinKite. They are the producers of the renowned Cold Card, the world's most trusted and secure Bitcoin signing device, built with a plethora of features fit for Bitcoin beginners all the way up to the most advanced of users. This device is a one-stop shop for your Bitcoin custody needs, and something the two of us have trusted for years. CoinKite also manufactures the Block Lock, a gorgeous e-ink digital display art piece sitting in the background of what seems to be every serious Bitcoiner on the planet. Block Lock can be programmed to scroll through key Bitcoin metrics including price, hash rate, next halving date, and much more. Boy, oh boy, will this thing look good in your living room or office. They're also the makers of many other security and fun products for all users, no matter their technical aptitude. Support our show and get a delicious discount on CoinKite products by following our affiliate link on the screen and in the notes, and using code BCB for 5% off the Cold Card.
Yeah, I'm going to quote you again here, Jesse, from one of your pieces and go back to basically them needing to screw over the holders of fixed income across the board. Like that is the only real way out of this. Yeah, because here's your quote. It's imperative for policymakers to gaslight the bond market into thinking that high inflation is off the table while secretly manifesting high inflation. Of course, policymakers won't be able to keep up the charade for long. And I think this is where, not that we're going to pivot into Bitcoin this early, but this is where people can get obscenely bullish, like the three of us at points, because when that leak in the pool starts to widen and people recognize that that's going on, they recognize the gaslighting, they see that they're getting screwed, and they start looking for alternatives, and they write down the list of places they could go and hide to preserve buying power, that list gets really small really quick. And Bitcoin's a leader on that list. And that's where this thing could move at the margin in ways that may make heads explode. But that is, I don't see how. I mean, I loved how you put this in that piece. I mean, that is, there's no way they're going. I mean, theoretically they could go taxes high enough, but then we have the deflationary concerns there and all that. Austerity, we've already established in this conversation, is laughable. It leaves one option, as you've outlined, and that's going to have consequences for the biggest or second biggest market on planet Earth.
Right. So, I mean, to really just put a fine point on it, the two options are overtly default and let the dollar collapse, or soft default and basically let inflation run extremely hot for a few years. Hope that you can and muddle your way through it before the bondholders wise up, and then kind of reset the system quasi carefully. You know what I mean? That seems unlikely, but you know what it is. What it is. The thing that really gets me bullish, now that we're talking about Bitcoin here a little bit, is this is all happening with the backdrop of the Bitcoin halving happening in the next 12 months or so. So every 4 years, as we're all aware, and we're going to let Jesse just tee off on for probably the next 10 minutes, because it's going to be, I mean, seriously, like you do the best job in the world of it. Like, we want you to just kill this. But this happening every 4 years, we're going to see only, 3.125 Bitcoins in the next epoch here. Yep. So, I mean, we're seeing a supply halving
I'm gonna get ready
in the most
this.
scarce asset in the world.
Hold on, we're cracking 2 beer. I'm gonna go here too. Here's the problem.
Dude, I didn't
with
know
beer.
we were doing this. You guys didn't tell me I had to have a beer ready for tandem.
I thought I was
Jesse,
going on a podcast with some firemen.
Yeah, it's been in reserve, Jesse, because when we do talk macro with someone like you, we're kind of tip at the spear. You know, we've said this on the show. We're at the edge of our knowledge and intelligence. So this doesn't help me, but fuck it. Here we go.
Yeah,
there you go.
It helped for the first 30 minutes, I'd say.
All right, so we are witnessing right now the coalescation. Is that a real word? I'm going to go with it.
Did you start drinking here? Did you just take a couple shots?
I mean, that's the word I'm making up. We're going with it. Coalescation. Yeah. Yes, it's coalescing into the halving happening at the same time at the backdrop of this entire bond market implosion potentially. Jesse, take this. Tell us how bullish we should potentially be or where this could end up.
Yeah. Okay.
Where to start?
Yeah, where to start? So, I think that, you know, everybody feels how it's kind of nasty out there right now, and it's a little bit shaky. And some people have decided that, you know what, it looks like we've stabilized after the banking crisis. It's going to be okay. Like, that was it. We're through that. I don't think so. I think that these things happen slowly. A deflationary crunch doesn't happen all at once. In 2008, Bear Stearns went under in March, and then obviously it wasn't until the fall, September, October, November, that the shit hit the fan, and people thought it was fine, you know, in the summertime. So I think that my base case right now makes me a little uncomfortable, because I think that we're heading towards a deflationary crunch that is going to hurt over the next year. And maybe it takes a year and a half to manifest. And I think it will alarm people, because I think that the system is more fragile than in 2008. And the way that they had to react to the banking crisis speaks to that. They didn't allow capitalism to play out. They had to go, backstop underwater securities for banks holding them, and they had to create a sweetheart deal for JP Morgan to take over First Republic, and nobody wanted to touch First Republic because of the how underwater their balance sheet was. And so the government created the sweetheart deal such that JP Morgan would get a 20% return on acquiring those assets every year. Thanks, taxpayer. You did that. And so ends. I think that the Fed's policies of raising interest rates and stubbornly trying to beat back inflation rates by raising interest rates is going to work too well. I think they should have stopped. They should have been. They're always a year and a half behind. They should have stopped. They should have started raising rates a year and a half before they did, when we saw inflation first pick up, and they were insisting no, there's no inflation, and then it's just transitory, and then we don't know why it's still here. They literally are operating with the wrong playbook about what is driving things, and as a result of that, they're constantly reacting and reacting with enough data in the rear view mirror that they can correct for, you know, the trajectory they're on, which ends up careening between deflation and inflation. And what they've done now with interest rates at 5%, you know, mortgages are now 7+%, and that means that for payments to come down to where they were, house prices have to come down dramatically, and that's going to break a lot of things in the financial system. So my base case is that we see a deflationary crunch manifest, and it's kind of alarming how deep and how quickly that drops everything. And then the Fed will be forced to step in with a scale of stimulus that, just like they did in COVID. I think that people forget that in 2019, in late 2019, the financial system was wobbling, and they had to do a lot of overnight repo to stabilize it. And then COVID comes along, and I think it just was a great excuse for them to inject a bunch of money to stabilize the financial system to prevent a crisis that would have happened if they hadn't. And that was them kind of getting ahead of a crisis, and they printed $10 trillion in the US and 20 trillion globally. So I think that we're going to end up, like, logically, I can't help but conclude that that's going to happen. That same scale is going to happen again. Starting a year, maybe a year and a half from now, they're going to step in and print a ton of money just as the Bitcoin halving arrives. And that should create absolute fireworks, because in the COVID, there's a great chart from what's his name, Julian Timmer from Fidelity, of the COVID stock market.
He's been ultra bullish lately.
Yep, the COVID stock market in one slide, and all these different stock categories are doing pretty well with all the COVID stimulus. And at the top of the chart is Bitcoin, because when you print a bunch of money, nothing does better than an absolute scarcity asset. So I think that massive force of, I think what's going to play out here, of a deflationary crunch that necessitates a stimulus on the scale of COVID plus. So 10 trillion in the US, 20 trillion globally. That'll have to happen, I think. That's the only way out of it. They're going to have to kick the can in such a gigantic way that the whole stock market will rip. The housing market will rip too. It actually scares me a little bit, because I don't own a house because I want it all in Bitcoin. So we rent, and I think that if my thesis plays out, then the same, like, COVID era housing bull market is going to happen again, and people are going to be scratching their head, like, why are we in a bull market right now? Why is the value of my home getting worth more? But it's not getting worth more. It's just that the dollar is becoming
rapid oscillations that happened in the Weimar Republic, which you pointed out in one of those pieces.
Yep.
It's like the rapid oscillations that happen on, like, a bridge. When there's the right frequency, a bridge can actually shake itself apart. Like, there's a resonant frequency that every structure has. And when that resonant frequency is hit and repeated, the impulse becomes greater and greater. It's like a wave is increasing the size of a wave, and it can shake apart a giant, robust structure by just hitting that repeat again and again. And it feels like that's what's kind of going on here.
The other thing I was going to say real quick is that this is where having a zoomed out understanding and perspective and research mindset, I think, is very valuable. So for somebody that has limited time, right, that's not working full time in finance, I suggest you not waste your time day trading or swing trading. Okay. Start learning high level, broad, macro liquidity debt dynamics globally. Because the problem is, when you get caught in the weeds, we're suggesting in that chart Josh just hinted at that you had in your piece, that's a very well-known chart of gold in the Weimar Republic. It's really hard not to get caught off sides in the midst of this volatility, in the midst of deflationary shocks on a broader, really significant inflationary timeline. It's hard not to get off sides.
You don't want to be leveraged at a time like this. You do not want to be leveraged.
Totally. And that's where I think the most helpful bang for buck for where to dedicate your research is more like decades long macro dynamics. And that's, maybe Josh and I are in the clowns, but one maybe benefit we have is we have limited time, right? We're career firefighters with young kids. We can't spend time
looking at daily, weekly charts and trends. All we can really do, and where we've invested a lot of our energy, is just in the broader macro fundamentals and plumbing. And that's where I really think the investment opportunities are. Make trades, dollar cost average into assets that have long-term potential based on macro trends, because I'll repeat it for the third time here. It's going to be so common to get caught off sides on a trade or lose conviction in something that's an absolute banger long-term, but didn't feel like it for 6 months or a year and a half.
Yeah. Yeah. And going back to what Josh was talking about waves combining, I think that in a funny way, we had a negative wave combined with the positive wave of the halving. The 2020 halving was a positive wave. Every halving is a positive wave for Bitcoin's price because of the doubling of scarcity of new supply. But we were in a QE environment, a quantitative easing environment in 2021, and then the Fed started to pivot right at the end of 2021, and I think that's part of why we didn't get the like blow off top craziness. It's that plus the China mining ban creating a bimodal top in 2021, and the extent of leverage, long positions, creating an incentive to be short Bitcoin. But I think that the pivot to QT was a big part of why Bitcoin didn't go as high as I think it probably would have. I think it would have gone to six figures had it not been for that. So now we're going into the halving, the next halving, and that's a positive wave. And they're in a QT, a quantitative tightening environment right now. But if that scenario that I just talked through plays out, they will be having to switch from like a very restrictive monetary policy climate and go back to that, when Kashkari was saying there's an infinite amount of money in the Federal Reserve, like that'll be the sentiment again, because they're going to be trying to put out a fire by throwing money at it, which, that's what their hose is connected to on their fire truck. They're connected to a vat of money, and that's how they deal with fires.
Yeah, they don't measure their arms like we do.
Yeah. So that's going to be a positive wave that stacks on top of the positive wave of the halving. So I'm increasingly seeing. I hesitate to say it's my primary case here. I think it's there's not enough evidence to support that yet, but I wouldn't be surprised if this next Bitcoin bull market outperforms the prior one. And every successive post-halving bull market has been smaller than the one before it, and that's the nature of the impact of the halving getting smaller, because you go from 50 Bitcoin per block to 25, 12.5, 6.25. And now it's going to be 3.125. That delta of 3.125 is less than the prior delta. But this other positive force that could amplify the upside for Bitcoin could mean big time fireworks in starting a few months after next year's halving, because it always takes a few months for the supply shortage to accumulate and start generating the supply shock in the marketplace.
Yeah.
So, my base case right now is that we see a bull market about the same size as the prior, the 2021 bull market. And I wouldn't be surprised if, because they have to print a ton of money and everybody's a little bit more aware of the inflation going on around them and the state of the fiscal situation, wouldn't be surprised if we have an even bigger bull market this time.
Yeah. Can you break down some of just the basic halving math? It's so simple, but I think it's important because people forget that this is the first commodity in human history with truly algorithmic supply. It sounds so simple to a Bitcoiner, but it's a massive cheat code because there's an element to this asset that behaves differently than any other asset that has ever existed in history. And it's quite simple. There's just a guaranteed mathematical choke point. Walk through some of those dynamics for us.
Yeah, I think a good starting point is to think about how do you go from no Bitcoin in existence to all the Bitcoin that will ever exist? Like, how do you go from nothing to 100%? And Satoshi, the creator of Bitcoin, implemented a very clever design of releasing half of all the supply in the first 4 years through by attaching 50 Bitcoin reward to every block, and a block is every 10 minutes, and so whoever mined that block gets that reward. That's how you fairly introduce this currency into circulation. And so first half in the first 4 years, the next 4 years, half of what's remaining. So if you think about that, it's 50% of the supply in the first 4 years was released, 25% in the next 4 years, and that math continues. So 12.5%, 6.25%, it starts to create a curve approaching an asymptote. There will only ever be 21 million Bitcoin. And we're getting pretty close to that now because we've gone through 3 halvings. We're about to go through the 4th halving. I think what's it now? It's like 8% of all the Bitcoin is left to be mined.
7 or 8%.
Yeah. And so when we hit the halving 11 months from now, that'll be 6.25, I believe, percent left. And then we'll mine 3.125% in the next 4 years, and so on and so on. It's so easy to think that like, oh, okay, that's a cute little gimmick and that's it. But there are 2 different things that does, which are incredible. And so we'll talk about the kind of less concrete one first. When you have an asset that has reducing issuance over time, it becomes a better store of value asset because you know that you're going to be diluted at a smaller degree over time, and that what it does is sort of morphs it from a primordial asset through like an evolutionary sequence. It's like Pokemon. If you got your Charizard, what's the Charmander, is your baby Bitcoin in the first few years of its life, and then every 4 years it evolves a little bit to become a better asset because people are going to be more likely to hold an asset that they know is going to be debased, diluted less. So you want to store your value in an asset like that, and so it evolves to become a Charizard level incredible store of value that has an infinitesimal extent of supply debasement every year, and eventually it'll be zero 100 years from now. So that makes it a more
it'll be a Charizard asset. Holographic in 2140.
Yeah.
It's Charizard holographic. Yeah.
Yeah. It becomes whatever's the tip top of all the Charizards ever. So that's like an intangible kind of. I think we often forget about that part of the story here because we think about Bitcoin as being the same over time, and it's not. It changes its attributes. Its nature goes from being a high supply inflation asset in 2011, which was part of why it was easy to acquire some, easy to spend it because you could easily replace it. It wasn't really a store of value asset. Fast forward 14 years, it's rapidly becoming the best store of value asset out there. Right now, the annual supply dilution is the same as for gold. And in 11 months, it will be half what gold sees every year. So all the gold mining efforts around the world every year add 1.5 to 2% to the supply of gold above ground. Yeah. And that happens every single year for the last 100 plus years. And Bitcoin is at that level right now. It is as good as gold in terms of its ability to store value without it being diluted over time. And 11 months from now, it'll be twice as good. So that's an evolutionary step. So that's part of why the halving matters. But then we can get to the more concrete supply, demand, price equilibrium mechanics of it. So I like to think of this time a year before the halving, when we've gone through a major bull market and a major bear market, and now we've sort of settled, right? And we're going sideways and everything's boring. I like to think of this as supply, demand, price equilibrium. We have found the right equilibrium level, roughly something like $30,000 right now for the kind of asset that Bitcoin is at this point in time, the amount of supply being created every month through mining, and the amount of demand and that ranges from institutions trying to increase their position to, and I think this is the real core of it, is sat stacking plebs who are buying up all the supply that's being mined. So we have found the equilibrium price where the amount of Bitcoin being created every month is eaten up by all the demand, the net inflowing demand coming in every month. And that price level happens to be 30,000. I think that the stock to flow model expected it to be higher for this point in time, but this is where we're at. And so I think the market is showing that this is the price equilibrium level for right now. So imagine this continues for the next 11 months. We go just perfectly sideways. Fine. No problem. And then the next halving arrives. And overnight, the amount of new supply being created every day, every week, every month gets cut in half. So right now there's 900 Bitcoin being mined a day, and at 30,000 per Bitcoin, that comes out to $900 million of Bitcoin per month that's being created, being mined. That's just in the supply schedule. And that's going out into the market and meeting $900 million of incoming demand from sat stackers. And that's why the price is going sideways. When the halving arrives, there will be $450 million of Bitcoin being created, but there will still be $900 million of demand every month from sat stackers. So then you've got this supply demand disequilibrium. You've upended your price equilibrium because there's not enough supply to satisfy all the demand at the current price level. So you start eating away at the supply that people are willing to part with anywhere around that price level. There's a certain pool of it. At any given time, there's people who are willing to sell. But every day, every week, every month, the demand is eating into that pool such that there's suddenly not as much left. Maybe there's none left at $30,000 per Bitcoin. And then the only way a market works is the price has to go find the level where it can find more supply. If there's too much demand and now there's zero supply left, you have to go find that supply, and the price moves to go find it. And that manifests as like bidders saying like, oh, okay, I can't get a hold of any Bitcoin right now. I'll raise my bid. I'll bid 31,000. And then you start having this little flywheel going of people raising their bids in order to find available supply, because there's not as much being created and there's just as much demand. And that sets in motion a whole classic flywheel of price starts to go upwards. People see the price going upwards. They don't want to sell their Bitcoin because they want to hold on to it because it's going upwards. And everybody on the sidelines starts to see the price of Bitcoin going up and they want in. Now there's even more demand coming in. So you've exacerbated this supply-demand disequilibrium. And that's where this parabolic advance comes from, which turns into a bona fide bubble.
Yeah, man. It's so simple and so profound. One of the things I've said before, and one of the analogies I draw from my past is I call Bitcoin a one-way miss asset. Years ago, I used to teach golf lessons. And when you're teaching good players who want to play competitively, they cannot miss on both sides of the golf course. They can't rope hook it off tees and then slice it off the planet. They need to strategically know that one side of the golf course is mostly out of play. And when we're talking about a commodity-like asset, Bitcoin, it really comes down to just supply-demand dynamics. It's a fairly simple equation. And with one side of the investment golf course completely out of play, let's call the supply side, this is the right side of the golf course, it's totally out of play. You cannot miss right. We know that those dynamics are going to remain constant and perpetual and fixed. And there's going to be a choke point that's going to drive value from that side. So then let's look at the other side of the golf course. You now have to argue. If you are a Bitcoin bear, you have to argue how and why demand is going to go down. And that is a really, really hard thing to do in the 21st century. This now loops into the beginning part of our conversation. Bitcoin is the hardest money in human history at a time when hard money might be in its highest demand, or some of its highest demand amidst the sovereign debt crisis. It's anti-fragile money, juxtaposed against an increasingly and comically fragile financial system. It's unconditioned money. And this is something maybe we may have time today. We may do it in a future episode, but we're in an age of surveillance, censorship, capital controls, currency wars, conditioned sovereign reserve assets. If we look at Russia, Bitcoin's frictionless money in a world with 180 freaking fragmented fiat currencies. My point in all this is that if you're going to make the demand argument, it's really difficult. And then if you teeter-totter over to the supply side, we've established that's a brick wall. And this is where I never use this word, but it starts to border in your head on inevitable that this thing is headed in one direction, unless there's just some totally off the planet obscene black swan event. Any follow-up thoughts there?
Yeah.
In my mind, dude, after listening to that, Jesse, I'm wondering what your thoughts on this are. I mean, this one-way miss, the only way that could be characterized this way and actually not play out the way you describe is if there are some very draconian measures that come slamming down on us. And I think that could massively affect the demand side, where that'd be like, the truck driving onto your golf course and your ball bounces off of it and ends up in the other direction, and like total black swan that we never saw coming. But
a fucking goose just picks it up in its beak and takes it across the fairway to the right side of the golf course.
A sparrow just gets smoked. You see just feather and blood everywhere. Like, ball's gone.
Crazy events. Yeah.
I don't know what else.
That's the only way the other side of the course is in play.
Yeah. Everybody thinks about like, what would it take to kill Bitcoin? And the last time I thought about this, the only scenario I could come up with was if you could somehow kill half of the demand right when the halving happens. And then you'd have to do that every 4 years.
Oh, I see. So that impulse kind of disappears and people start losing interest, and it just kind of circles the drain from there. Start9 operating system is a full-fledged, cutting-edge Linux operating system. Its functionality and adaptability make it an excellent choice for the users who value simplicity, efficiency, and privacy. Running a Bitcoin node? Start9 is your go-to solution. Setting up a node has never been so easy. With a Start9 server, backups are more than just an afterthought. At the push of a button, create encrypted backups, ensuring your data stays safe and sound out of the reach of big tech companies. Start9's commitment to security goes even further. StartOS is encrypted for all LAN communications. This ensures your passwords and assets are always protected. The StartOS marketplace of apps includes everything from Lightning to secure messaging apps to secure password management. If you care to be sovereign in the digital age, running a StartOS server is a must. And the best part? You can download and set up StartOS on any machine, or you can purchase a plug-and-play Start9 server directly from Start9. Choose Start9 for a secure, streamlined, and flexible computing experience. When Dan and I are at the firehouse and we have finally delivered the orange pill to a new plebe, we recommend Swan for their first Bitcoin purchase, always. Swan has the user interface absolutely nailed. We have seen people go from no-coiners to Bitcoiners in under a minute. It's just that easy. The problem with sending friends and family to other exchanges is exposing them to all kinds of BS. You will never see Swan encourage your friends or family to buy Dogecoin. Instead, Swan educates. Swan produces some of the best educational content in the space. That is a big freaking deal. The difference between somebody who buys on a whim and sells for a loss and those that hold for the long term is simply an education gap. We have been using Swan to dollar cost average into Bitcoin every single day since 2020. If you want a family member to turn into a Bitcoiner, there is no better place to go than Swan. For daily DCA, IRA, or education, Swan is the place to go. You can try Swan Premium on us for free. This includes exclusive Swan content, market insights, and other discounts. Click on our link in the show notes and use password BlueCollarBitcoin.
Yeah, and that would be basically impossible to do, because if you're a sat stacker, you believe in it. You're acquiring sats because you know the halving is coming. So you're not about to lose interest right when the halving arrives. And then logistically that would be impossible too. And then you'd have to do it every 4 years, because if you did it once, maybe that is like a muted post-halving bull market, and the sat stacking believers who are left would still be stacking sats. And then 4 years later, and the next halving comes, and oh look, the mechanic is back in action. Price moves upwards. We have a little bubble. Goes too high, crashes too low, stabilizes somewhere in the middle, and you keep going. So yeah, it borders on inevitable, and then when you really just stew in this, in the logic of it, the mechanics of it, and you get lost in that for some time, which I sometimes do. I sometimes spend like hours just thinking about this stuff.
Us too.
You come back to inevitable, and then it's kind of hits you over the head how there are these little memes that number go up. That in 3 words is what Bitcoin is designed to do, and it's this oversimplification of these mechanics and the nature of Bitcoin. But number go up, and you just have to hold on through 4 years of volatility, and you need to understand the mechanics under it in order to have the conviction that number is going to go up. But number go up. That's all you really need to know about. That's all you need to know about Bitcoin in order to incorporate it into your saving strategy, like how you are saving for your future, for your family's future. Because right now maybe you've got a mortgage, maybe you've got stocks and some bonds in your portfolio. Maybe you have a little bit of gold. If the national debt scenario that we're talking about plays out, the bonds in your portfolio are screwed. The stocks will underperform in real terms. The house will probably do best of those because it's a hard asset. But it will suffer because the economy is hit, and everybody's net worth drops because the bonds disappear.
And in my area, you pay 3% property taxes annually. So there's a rider on the whole thing.
That'll kill you.
Yeah, and as we approach,
hold on one sec before you move on. I don't want this to get too far removed from you saying number go up, because I was having a really hard time not cracking up. You are one of the most intelligent people that I've met. Your work is so well done, and hearing you just say number go up and thinking of that meme where it's like the total bonehead idiot saying the same saying, the bell curve with the average person saying number go up, that doesn't make any sense, and then the genius saying number go up. It's just eating at me right now and making me laugh. But
wait,
you were
guys,
clearly
it's like
that number go up is literally all this is about.
Yeah.
It's what grabs people. And then you think that is so boneheadedly stupid to say that. And then you dig into it and you go, that's exactly what this is and what this is programmed to do. It sounds so brain dead. If somebody just tuned in to listen to that portion of it, they'd be like, see, I told you these people are just a bunch of morons.
Yep.
This is the Blue Collar Bitcoin podcast is what they would say. Yeah.
And
exactly.
And it's just funny, like recursive thing, because number go up because it is programmed that number go up. And then people realize
that's going to be the intro for this. It's just gonna be you saying number go up.
Yeah, okay.
Dude, I mean, I honestly, Josh, I love
that. There's a last piece of people recognize
number go up.
This thing is designed to go up so that they then pile in, and that makes it that self-fulfilling reality of like you buy the asset because it's desirable, which makes it become more valuable for everyone else. So how do you change the world? How do you change the world of value? You have to invent something that is designed to be better than everything else out there.
You have to introduce an obelisk to a bunch of apes.
Yes.
And get them to worship it.
Yeah, that's great.
And that's how you change the world.
Yeah.
2001: A Space Odyssey. If you guys haven't seen it, it's a great movie.
Yeah.
Josh, you hit on a really deep, I'm going to call it insecurity of mine with this whole Bitcoin thing. Oh. It's that I have so much conviction based on this brain and these two eyes and a few thousand hours of research at this point that I just want to grab people that I care about and just say, trust me, number go up, like we're saying. Okay. Yeah. It's like your sailor friend, Jesse. I think he's a sailor or something. You just said, dude, this guy got it right away. You told him about it. He latched onto it. He started stacking. But
number go up.
That approach is so contradictory to a large degree of, I would say, healthy self-skepticism that I have. I'm keenly aware of the limits I have to my knowledge. I'm aware, Josh and I are both aware that we've had deep convictions about other things in our life that have totally fallen flat on their face. I've been totally sold out for things that didn't pan out before. Okay. And so in some senses, I'm just always bombarding myself saying, you could be wrong. You could be wrong. You could be wrong. But this one seems like such a slam dunk at this stage that I'm getting to a point, and as the years go on, I increasingly so, where I sort of violate that rule and I start grabbing people I care about and say, I'm putting myself out on a limb here, but just trust me, get some of this and get enough of it where it could really affect your life. Because I'm going to quote Bill Miller here you included this in one of your pieces. There is no existential threat to Bitcoin, said Bill Miller. And there are insane events, the goose picking the ball up on the left side of the fairway events, but those aren't logical ways to proceed. And like you said, you spend hours thinking about this. Josh and I do too. I'll go out on a nature walk and I'll play games in my head of how does this break down? How does this fail? Where am I missing it? In what fashion am I captured? Blah, blah, blah. And when I really dig into that, I always reach the same conclusion of this is probabilistically so obviously the best place to park capital right now. It's not even funny. But you just sound like a clown when you say these things out loud. I completely agree, Josh. And I'm glad you brought that up because
it's funny.
Yeah.
Oh, Jesse, while we're on the topic of does this make sense? Does this not make sense to a lot of people when they listen to this? They sound like we're all idiots. How's your friend Dan doing? Is he coming along? Is he still think we're a bunch of clowns?
Let him listen.
Any movement on Dan?
One. Yeah.
Yeah. So for everyone, Dan is the name I gave to a buddy who was featured in my Yuppie Elite article, which I suppose is the piece I'm best known for. And we went to Stanford Business School together. And the last I heard from him on Bitcoin was I probably asked him about 6 months ago, and he was still poking holes in it a little bit. He was more interested at the top. And then I was at a wedding in Hawaii where he was, and he was there, last summer, right when we were falling through 25,000. It was, bad timing, of course, to be in Hawaii and have that happen. Yep. And I asked him, Bitcoin's price had been at 30,000 like a day before, and I was like, would you buy a Bitcoin just to have one if you could get it for 25,000? And he was like, yeah, I probably would. And I was like, guess what? You can do that today. And, of course, as soon as the price of Bitcoin is now 25,000 rather than the 30,000 and a discount he thought he was getting, he wasn't interested anymore. So at some point, everyone has to come to terms with what Bitcoin is doing. And I was going to mention this earlier that, I think part of the problem for people from my kind of background is that we were taught that the efficient market hypothesis is true. And Bitcoin's entire design flies against the efficient market hypothesis, which says that to believe in the efficient market hypothesis is to believe that the market will price in all information accurately.
Right.
Mm.
And if that was true, then the halvings would be priced in. Because just 11 months from now, an event will happen. And the last time it happened, from the date of the halving until the peak 12-ish months later, was an 8x. And the same mechanics are about to play out. And maybe it goes a 4x, maybe it goes an 8x, maybe it does a 15x. But that would mean that if that's true, and you wanted to ride that, and if you're thinking about acquiring that position now, you'd be looking at 2 years from now to a peak to get a 4x, 400%. Where else are you going to get that in 2 years? It's an incredible bet to be making based on everything that's all the information that's out there. But what's happening is that there's an understanding gap, because you have to break your paradigm about how you think markets work, what you think the value of gold is, and why people value it. The Keynesian view on things is that gold bugs have a screw loose. They just like shiny things, or there's some ancestral memory of being a pharaoh or something like that, and people are playing pharaoh by buying gold. No, it's not about that. It's about a scarcity bet. It's about valuing scarcity and storing your work, your time, your energy that people have paid you for your time and energy, and you are storing that value in something that can't be debased. That's why people value gold. And so, the efficient market hypothesis says that if Bitcoin was going to be worth a lot, it'd be worth a lot by now. If increasing scarcity mattered, it would be worth a lot by now. But that doesn't jive with the mechanics of every month there's $900 million of new Bitcoin being created right now. And that goes out into the market, and you can't price that in advance. That's the Bitcoin that's created tomorrow can't be accounted for today yet. Like that force has yet to be, delivered to the market. So what are you doing trying to, if from your armchair say that this or that can be priced in when that economic force hasn't played out in the market yet? So, that's a big part of why people with my background don't get it yet, is they think that the only, like, if this thing was valuable, someone else would have figured it out by now and priced that in, and that would mean it would be at its terminal value today. But when you introduce something brand new to the world, day zero, nobody understands it. And it's not like day one, everybody understands it. That takes time. And in terms of how humans think about value and finance, 14 years is lightning fast, within a generation. You can't move any faster than that in terms of going from something with no value to something with a ton of value.
I was thinking when you were talking about this, the parallels between, like, say, Alan Turing, who was the inventor of the modern computer, and like a Hal Finney. Turing was talking about intelligent machines, in the 1940s, and I think it's because somebody who's like a proprietor or an inventor, or somebody who sees long and sees the real basic fundamentals underlying this, can see far into the future, because they can make a lot of leaps between where we are now and where we're potentially going, because they just fundamentally understand this thing. It made me think of Hal Finney and his prediction in 2009 about each Bitcoin potentially being worth $10 million. Because if you extrapolate his understanding of what this was potentially to what it could potentially be, having those first principles and understanding this, it made sense that that was a real possibility. And in 2009, it sounded crazy, just like in 1945, it sounded crazy for machines to have any intelligence whatsoever. But both of those things seem to be prophetic in retrospect. But I think really it has to do with people just having very, very deep fundamental understanding of what it is they're talking about in a very early part of a technology's development.
Yes. There is a reason that there is a unique degree of information asymmetry surrounding Bitcoin. This thing really, in a lot of ways, does the impossible because of the advent of numerous new innovations, the internet, public-private key for cryptography, blockchain. All these things coalesce in this new technology that is very alien appearing and otherworldly for people that have swam in the traditional markets for a long period of time. So this absolute scarcity protocol that can move at the speed of 21st century finance really does seem impossible and doesn't click for a lot of people for very good reason. And the same is true for the three of us. It took me a while to really get this. Even with my firefighter economic knowledge, it didn't make sense. It didn't fit the boxes. It wasn't something Dave Ramsey wanted me to buy, Jesse. And so it's no wonder that there's opportunity, because it's a complex thing to understand. It works. It's going to continue working. It's going to underpin a lot of things, but it takes time to digest. It's understandably complex.
Yeah. And part of that is that you, in many ways, you're better off not having an existing understanding of how finance is supposed to work when you come into Bitcoin. And I think that's part of why blue collar guys get it, and then venture capitalists turn their nose up at it because they deeply know a version of finance that works in the money printing world. And that money printing world is it's very complex and ornate. There's all these crazy little mechanics of how the piping works in that world, and it's hard to get. But as humans, we can understand. We can understand gold. Like, that just makes sense. It's rare. It's hard to come by. It's shiny. It's pretty. You can make things out of it. And when I value it, my value propagates into the future effectively. So, you kind of have this, it's a heuristic that ends up working of like, oh, shiny, rare thing I can make jewelry out of. That becomes a nice little shortcut to scarcity. What you're actually putting value in is something that propagates value into the future effectively because it's not diluted. That's scarcity. And so it's in us to appreciate scarcity. We can understand something that there's a limited amount of. And that's because we've been doing it for 70,000 years since shells were around. We've been valuing shell money for 70,000 years. There's evidence of that in cave sites. Shell pretty, shell rare, shell valuable. That's just like in our language. DNA. And it doesn't take much to understand, like, oh, a rare thing that you can't make more of is valuable and is worth storing value in. So, the venture capitalists who turn their nose up at Bitcoin, they've learned this fancy or crazy system that they think is the end all be all. But, the firemen, the blue collar guys can come into Bitcoin and just use their head, about what do I think, rather than what do, all the academic textbooks that I've learned over my years of, being an MBA or in finance. Like, forget all that. What do I think is valuable? Something that's rare, something that can't be debased, something that can't be taken from me. And so that's why this we've seen this incredible opportunity for blue collar guys to arrive at Bitcoin, use their head, not trust the intellectuals who frown on Bitcoin because they don't understand it, because it's not from their world, and use their own head instead and say, no, this is something I want to own. This is something that I understand why it's valuable, because nobody can take it from me. Nobody can debase it. And because of that, it's going to store and propagate my value into the future effectively.
Go up.
Yeah. And I think we need to give you one last assignment here. And that is to walk us through. You have this Bitcoin's full potential valuation piece. It's gotten quite a bit of traction. I think Saylor even was tweeting about it. You're making waves. Walk us through some of the thesis there of where you think this could go. Bullish and bearish cases for the future trajectory of this asset.
Yeah. So I guess to tee it up, how much value is out there? This is a question that we all should have asked at some point, and nobody talks about. But I did the exercise to go find how much value is sitting in these different asset classes. There's $900 trillion of value in the world. 300 trillion of that is in real estate. 300 trillion is in bonds. 120 trillion in money. 100 in the stock market. 12 in gold, and $500 billion in Bitcoin. So $500 billion in Bitcoin. That's your landscape, your global asset value landscape today. And then the question becomes, okay, if Bitcoin has these superior properties when compared to other store of value assets, it's better than bonds, because bonds are going to deliver negative real returns. But Bitcoin has this increasing scarcity mechanic that causes it to see true real value appreciation over time. So right there, every bond in the world is inferior to Bitcoin. Yet there's $300 trillion of bonds and $500 billion stored in Bitcoin. So do you think that some of the value stored in bonds, some of the people who have bonds in their portfolio are going to realize, you know what, I want to have more of the thing that's getting more valuable and less of the stuff that's losing me purchasing power over time? And they're going to sell their bonds and buy Bitcoin. I think that's logical that will happen. And that's true of every asset class, because Bitcoin has these properties that make it, as far as I can tell, superior to every other asset class out there as a store of value. It is going to reliably propagate your value through time if you can withstand the volatility in a 4-year cycle. And it will grow in purchasing power because of its increasing scarcity along the way. That's my understanding of these mechanics. That's what has happened so far. That's what I think is going to keep happening. So then the question becomes, all right, so $900 trillion of value, how much of it would rather be in this unequaled store of value asset that has properties that no other bucket in this landscape can match? Well, maybe all of it is then the thing that you jump to. There's no reason why it wouldn't be all of it. But then you have to think about, ultimately, nobody's going to be 100% Bitcoin long term. You're going to have a house. You're going to want to own part of a company. So nobody's going to be fully Bitcoin. And so then then it becomes a question of, all right, if Bitcoin doesn't have a ceiling because there's eventually no supply creation that dilutes for example, with gold, because it has 1.5 to 2% of new supply created every year that's then put out into the market has to absorb that in order to sustain a price. And that has worked out to be 12 trillion. If the price of gold was 120, if the value of all the gold in the world was 120 trillion, if it 10x'd, then the value of that gold being created every year would be 10x as much. So you would need to have 10x as much demand in order for the price of gold to go sideways. And if you don't have that, then the price of gold falls down to its equilibrium level, which ends up being 12 trillion. You don't have that problem with Bitcoin over time because the amount of supply being created dwindles down to nothing. So that ceiling function, that thing that keeps the value of Bitcoin from just expanding infinitely, doesn't exist. And so then it becomes a question of how much of it do you want to have in your portfolio, rather than how high could it go. It could go infinitely, but then it becomes a question of human behavior, of like, how diversified do people realistically want to be? How much do you value having real estate? Like, how much do you value owning a Van Gogh versus having another fraction of a Bitcoin? At some point there, people want to have other assets, and that creates the ceiling of what's possible for Bitcoin to, what percentage of the total global asset value landscape could Bitcoin become. So the way you can come up with like a full potential valuation with those things in mind is by going down the list of the different asset buckets and saying, all right, so there's this much value in bonds and gold and real estate all the way down. And then ask yourself, for each of them, because of how this category stacks up versus Bitcoin in terms of its properties, in terms of what people are trying to achieve by holding that asset, what percentage will eventually want to be in Bitcoin instead? And so, like with bonds, I think it's higher than it is with art, because people own art as like a trophy. People hold bonds because they're trying to preserve their purchasing power. It's not sexy. You don't get anything out of it. You're just trying to propagate your value into the future. And Bitcoin does that better. So a greater proportion of bonds will migrate over to Bitcoin when they realize these mechanics. And so I went through the exercise of really just like my gut feeling about each of these individual asset buckets. How much of the value stored in these buckets will end up wanting to be in the superior asset because of its properties as a store of value asset, and not for any other consumption reason. And the result I got out of that was that 25% of the world's value could migrate into Bitcoin over the next few decades. This will take quite a bit of time.
Coincidentally, that $10 million number matches what Hal Finney said, as we mentioned a little bit ago. It's interesting.
Exactly. So that 25% of the world's value, when it's $900 trillion of total value, comes out to $200 trillion that Bitcoin could consume and be worth, and that is $10 million per Bitcoin in today's dollars. And of course, this is something that's not going to happen this decade. This could happen within our lifetimes. That kind of time scale. And that's just like, that's the full potential valuation. So like that's an intellectual exercise of how high could this thing go, like maximum. And what's different about this asset versus any other commodity out there, and that includes like art, is this new supply issuance goes to zero over time. So that that natural bound that you have from new supply creation, having to go out into the market and be absorbed by the market, doesn't exist long term. And that keeps art from being more valuable, even though no individual artist is, like, you're not making more Van Goghs, but you're making new artists and you're hyping them up and you're creating the new it artist. And then the dollars in the fine art market are bidding for their newly created works. So there's a limit there too. Like, so that's true of gold. That's true of art. It's even true of real estate, because if land was incredibly valuable, if for some reason we stored all of our value in land, people would make more land. You would dredge swamps. You would cut down rainforest. These little things at the margin that you can do. And on top of that, there's like square footage in real estate, the built environment, which also is part of that dynamic too. So, Bitcoin is the only thing out there that has this, it doesn't have a natural ceiling. And so as a result of that, it can float up in value until there's some natural equilibrium about human behavior, about how much they want to have in their portfolio.
If I was to summarize where we've been in this chat, it's essentially, we spent the first part enumerating the dynamics of why hard money is so prone to perform well in, say, the next decade or two. And in addition, why we currently have access to the best hard money the world has ever seen. Those two things are coalescing at the same time. When Larry Lepard was on this show, I think it was the first time, he talked about hard money dynamics in the 70s leading up to 81, kind of the last time we really saw this thing rip. And gold got to 7% of global assets, which today would be in the ballpark of about 35 trillion. We're currently looking at tradable gold, say 5 to 6 trillion, Bitcoin significantly below $1 trillion. So let's say that's a total of 7 trillion. So in my head, I've used that shortcut or that example to say, it seems like we're going to be in an environment where hard money is going to be in significantly higher demand than when it was back then. There's a lot of reasons that could be posited. And here comes this thing. And in some ways, I think through that is like the lower bound of where hard money is going to get to. And that's crazy to say that that's the lower bound, because even dividing that by 21 million or half of that by 21 million gets you to a very significant number. Yeah,
in my mind, the very lowest bound for what Bitcoin will become is gold today, which is $400,000. Would be $400,000 per Bitcoin, and that's as low as I can see it going. And to your point of the era we're living through and what happened in the 70s. In the 70s, we defaulted on our debts in a way around paying for Vietnam. Like, that's why we went off the gold standard, is we had to pay for Vietnam. So we said, okay, well, the dollar isn't equal to gold, and we'll make more dollars and pay. And we never went back. And so obviously since then we've been on a 50-year bender of fiat money. And, we might have done a minor default on our debts in real terms in the 70s. But now that entire house of cards is in jeopardy. And it will not be a minor default because of the scale of debt that has been accumulated. But all that debt is sitting on somebody's balance sheet right now.
Yes.
And that is all, everybody there who has debt on their balance sheet faces a decision every decade now of, do I want to watch that go up in flames, or do I want to sell it before that happens and put that money into a different asset that achieves the same goals of propagating value through time?
Jesse, thank you for joining us, man. We'd love for you to give a handoff to Once in a Species, because we want people to get the most eloquent way for you to impart to them that number goes up that we can possibly send them their way.
I think you should retitle it. I think it should be titled "Number Go Up."
Number go up. That's
so.
Good. Yeah, I don't know. Sometimes I'm effective on podcasts at articulating these concepts, but I'm so much better at writing it down and editing it and making it clearer that way. So if any of this was interesting and you want to get the full story and the full effect and see my other writings, you can go to onceinaSpecies.com and sign up with your email to get my newsletter. It's you can be a free subscriber. There's another tier too, but sign up as a free subscriber, and that's where I'm putting out all of this analysis. That's where the full potential valuation article lives, and future analysis like that. So yeah, I appreciate people signing up for that, because I'm trying to get the message out, and frankly, I'm trying to arm people with good material to forward to their friends and family.
Yeah.
And I think that format, the email of Bitcoin analysis that arrives in your inbox, and you can decide if it's worth forwarding to somebody, is a good way to do it.
I grew horns during this discussion and reading a lot of your work this week. You've got me real bullish. And for good reason. It's not just that this is what this project is all about for the two of us. Mm-hmm. We're going to flip the script. We're going to change the thesis the moment that the evidence goes the other direction. But in the 5 or 6 years we've been studying this, that has not yet happened. And I'll say it every time we get on these microphones. If you're not taking a hedge position in this thing, at the very least, I have no fucking idea what you're doing, because it seems so obvious and so important for a lot of portfolios, especially people in our demographic. Things are getting tight. Things are getting precarious. Things are getting stressful. And there's not a ton of options to get out of this dynamic. There really aren't. The strategies afforded to a firefighter to navigate this and have enough capital to live a happy, healthy, full retirement, they're limited. And this is an incredible opportunity for very logical reasons, many of which we outlined tonight. So Jesse, I appreciate your time, man.
I think it even, I would hazard to say that we could end up with a very stark barometer of financial success, of people who can retire and people who cannot retire from our generation. And I think that it will be a very clear correlation that the group that can retire is the group that got some Bitcoin before the rest of the world caught on. And the group that can't retire is the group that dismisses Bitcoin until half the world has already adopted it.
Wow. Yeah. I'm just going to click stop. That was profound enough.
Jesse, thanks, man.
Yeah, for sure, guys. Looking forward to next time.